tailwind for margins and productivity, and that's what the market is. That's another factor in our more positive view over the next 12 months.
Well, I actually want to go back to the bond market. Speaking of the deficit, you know,
Yes.
you mentioned before the break that things are actually looking a little bit fragile, not so much in the equity market, but perhaps the bond market. And I'm curious, in your role as chief U.S. equity strategist, how much time are you spending looking at the 10-year yield?
Well, I spend a lot of time looking at the 10-year in any environment because it is the pricing mechanism for all assets. You know, as we've said for years now, 450 is kind of that crossover point, and it still continues to be a crossover point. When you get north of 450 on a 10-year, you start to see negative correlation to equity multiples. Okay, so we're right around that level. And by the way, I'm pretty sure the authorities know that as well, so they try to defend those levels. I don't think we're going to see a real defense.
Authorities meaning the Fed.
You know, all of it, Fed, Treasury,
but not Congress. You're not.
Well, Congress is a different animal. I mean, and I've made this statement before. It's maybe controversial. I believe Treasury is somewhat captured by Congress, right? They got to fund it, and the Fed is somewhat captured by Treasury. They got to help out. So they work. You know, it starts with the spending, and then it trickles down. And so, you know, I don't think we're going to see an aggressive action until we get to 5. If we get to 5%, we said this last time, going to 5% is going to be bad for stocks in the short term.
Right.
However, if we get to 5%, I'm pretty confident they're going to intervene.
Well,
and that will be positive.
For better or worse, it feels like we are just glued to 4.5%. We just toggle around in a range around
until we
that
get
number.
over it.
Until we get over it.
And then we watch for 5.
But then we go back down, and we're back at 4.5%. At least that's been the story of the past couple months. So, Mike, what do you make of that?
Well, I would say the other side of that too is, like, let's not ignore what's going on in Japan. Okay, so you know they're way ahead of us in terms of using, you know, the money printer to kind of backstop bond market. They've been doing it for 30 years, right? And QE, they were the originators of that, and you know, we followed suit. And so now the question is, okay, now they have inflation. Okay, and the yen, by the way, is, you know, a big part of that. So the question is, can they control the yen's movement? I don't know if they're more focused on the yen going south of 140, okay, or they're more focused on keeping JGBs from blowing out to higher levels. But it appears to me, as an observer of markets, that, you know, when the 10-year yield or 30-year yield gets to a certain level in Japan, or the yen gets closer to 140 against the dollar, we also see intervention. So these are all related. These are all related. But the fact that we're seeing these things get pinned around these key levels suggests to me that they're observing it, and they're gonna try to control that.
All right, keep an eye on Japan. We'll be doing that over the weekend. Hope you have fun too. That is Morgan Stanley's Mike Wilson. Great to speak with you. Let's take a closer look at this market right now. It is the end of the month, and things could get weird as we get closer to the close. But at least where we stand right now, we're looking at very slight losses. And you take a look at the breakdown of this market. There's more breadth to the downside. You can see that only 139 names in the S&P 500 are higher right now, much more to the downside. You have one relatively big gainer today, and that is Costco. This is an earnings story, of course. We heard a little bit from the company about how they're navigating tariffs, and shareholders seem to like that news. You also have Netflix and Palantir moving higher. You take a look to the downside, though, and this is where things could get dicey, because your biggest loser on a points basis right now is NVIDIA, chopping about 5 points off the index, down about 1.3%. Then you have Apple, Amazon, Tesla also trading to the downside as well. That could become a big weight as we get deeper into the trading day. But let's take a look at the sector level as well. It's broadly the same story, limited upside here. Consumer staples taking the lead right now. That, of course, comes down to Costco. You also have utilities in the green as well. A very defensive setup on the last trading day of the month. You go down the list right now, tech, healthcare, and energy in the red, Matt Miller.
Yeah, all red. We could turn around and see some gains at the end of the day, right? It's the last day of the month. A lot of window dressing could be in store. Coming up, one more measure in President Trump's proposed tax bill is alarming Wall Street. A real concern, especially for foreigners or investors in foreigners. We'll tell you what it is next.
All right, it's time now for top calls. Some of the analyst action in focus this morning. And first up, Airbnb getting cut to a sell over at Truist thanks to soft summer leisure travel trends in both the U.S. and in Europe. Next up, we have Rockwell Automation getting raised to a buy over at Barclays. The firm cites an improving sales outlook for the manufacturer. And finally, I want to highlight the ag firm AGCO getting downgraded over at Citi. The firm says it sees less upside in shares following a 30% post-Liberation Day rally. Shares currently off by about 2%, Matt Miller.
All right, thanks for highlighting AGCO. More now to on one of the most read stories on the terminal, and one that I have been obsessed by since I read it last night. It's so well written. I highly recommend you check out this story on an obscure tax item in one big, beautiful bill. Wall Street is growing wary of what is known as Section 899, or the Revenge Clause, Trump's tax treatment of what he's doing with tariffs. If signed into law, it could repel foreign investors even more. Deutsche Bank says the tax amounts to, quote, weaponization of U.S. capital markets into law that challenges the open nature of U.S. capital markets by explicitly using taxation on foreign holdings of U.S. assets as leverage to further U.S. economic goals. We're joined now by Bloomberg's managing editor for markets and editor on this story, David Papadopoulos. David, fantastic story by Yishi and Liz
I like
McCormick.
the hype.
Yeah.
Well,
he doesn't say that to just everyone.
Look, so what really is in this legislation is that, you know, if another country is hitting us with taxes that we don't find fair, we're going to clobber them with taxes as well. But it seems to me like this is Trump's tax version of tariffs. Like he's just looking to take money from foreign players that want access to this market.
I think that's right. I think what it is of a piece with this administration and this president's view, Matt, that it's an incredible privilege for foreigners to have access to our markets, to have access to our treasury bonds, access to our Mag 7 stocks. And so, you know, if you want that access and you happen to be from a country that we deem is treating us unfairly from trade perspectives, pay an additional tax. If this bill approved by the House, goes through the Senate, is signed by the president, it would be on some investors an additional tax of as 5 percentage points, and it could go up from there.
So I want to talk about the scope here, because you mentioned Magnificent Seven stocks. We're talking about U.S. assets broadly here, right? Is there any one asset class that is particularly vulnerable?
So, Katie, I would say that for starters, some of the details are still a little fuzzy for us and for others, but our sense is that the thing that would be affected the most and hit the most is income that investors earn on treasury bonds. Of course, outstanding U.S. treasury bond debt, somewhere around $30 trillion. That throws off an enormous amount of income each year, a huge amount of that. Don't ask me for the exact percentages. I don't have them in my hand.
Read the story.
Read the story. A huge percentage of that is in the hands of foreigners. And yes, if you are from, as of right now, from France, the UK, Canada, Australia, among other countries, you will now pay this additional tax if this bill goes through. Listen, it's a gambit that I suppose can work, and I can see what they're going for. But Matt, at a time when the whole American exceptionalism story is really in question, and investors are already kind of fleeing U.S. markets. U.S. markets are by far underperforming global markets. It's another thing that's sort of just like nudging investors to
leave. It's like asking investors to leave. Please take your business elsewhere, you know? Don't list your company here. Don't buy our treasuries. I mean,
it's just curious to me because typically at times like this, when a country is effectively dealing with a bit of a trying to stem what is effectively capital flight, they usually say soothing things, and they try to keep investors hanging around. May I offer you a drink? Sit down, hang out. Hey, maybe a little bit higher interest rate. Here, you're right. To a certain extent, it's a little bit like, may I show you the exit door? Let me lead you there.
I mean, John Farrow always asks on surveillance if we can still expect foreigners to finance our purchases if we're not purchasing their their goods, right? And this is, I think, along the same lines. Can they still be expected to finance everything we do if we're not letting them play here or profit off of our markets?
Well, there's no doubt that there's a real risk that, as amazing as the U.S. dollar is, as incredible a currency it's been as a storage of wealth and as a means of transaction, as incredible as U.S. markets are, the U.S. consumer market is, if you keep doing things that are potentially suddenly cutting them off from those markets, yes, you will discourage them to the point where they'll say, heck, I'll just simply go somewhere else.
So where does this go? Because you take a look at the market reaction to this, there hasn't really been much to speak of. I mean, reading this article, this is the most detailed account I've read about this proposal, and I'll stress that it's a proposal. What is the
Well, but it's a proposal, to be clear, but that has been approved by the House. So, yes, the Senate could tear it up. It's possible, but it is well, we don't frankly exactly know what's going to become of it in the Senate. There's speculation that it will indeed get thrown out. There are also some who believe that there is going to be Republican support for it in the Senate. We'll find out. We don't exactly have that answer right now. What I can tell you is this. Tax lawyers, going back 2 months ago, were initially onto this. While the rest of us were sleeping on it, and Wall Street was sleeping on it, they were starting to spread the word. It only really jumped up onto the radar of Wall Street a day after the big, beautiful bill was passed last week. There was small rumblings Friday, slightly louder rumblings early this week, and then in the last couple of days, it's gotten really cacophonous out there. And
I hadn't heard anything about this. I hadn't read a less detailed, I hadn't read a broader brush strokes account of this, to the point where I was actually surprised that Yi and Liz got so much commentary from the pros. I mean, everybody's been sidetracked by the taco trade.
Yeah, that's true.
And now we're reading about Section 899.
We should have all been listening to those tax lawyers.
Yes.
Luckily,
Matt, listen to your tax lawyer.
There you go. Luckily, of course, David Papadopoulos and the markets team had it covered. Really appreciate the time and reporting. Encourage everyone to go on Bloomberg.com and read that story. But coming up on this program, the S&P, it had a stellar month, but cracks are emerging as we roll into June. We'll tell you why next. This is Open Interest.
This is Bloomberg Open Interest. I'm Matt Miller. Quick check on stocks, and I feel less confident about my prediction that we could turn around today. We're not down by too much. S&P 500 off 0.6%. And Katie, as you've been saying, we're up 6% for the month. So it's the best month of May since 1990. NASDAQ off a little more, 0.75%. But with these big behemoths down so much, when Nvidia's off 2%, it's tough to get a gain. Apple is down 1%. Google off 1%. Tesla down a little bit less. The Gap has lost fully a fifth of its value today. Only Costco, at least on this board of chiclets, only Costco is gaining here.
There you go. Well, we'll be speaking about Gap in detail with the CEO next hour. But let's talk a little bit more about the month in markets. The S&P 500 now up by only 5.5% in May. That is still its biggest May gain since 1990. By far the best month of 2025. Let's discuss with Bloomberg Markets reporter Michael Ball. And I just keep coming back to the point that sell in May, especially this year, would have been terrible advice. You should not have sold stocks heading into May.
Yeah, this year was different because of what happened in April. The rebound in May made sense from a lot of perspectives with the step down in max protectionism and tariff war. But overall, now we're going into a much more questionable period for the rest of the summer.
The best May since 1990 seems like a lot. I mean, that's 25 years ago. You were born.
That's
already.
more than 25 years ago.
Oh, right, 35 years ago. No, Katie wasn't even with us.
I didn't exist.
Michael may not have existed. Is this all about the turnaround? I mean, did we just plummet so far in the month previous that this is about catch up?
Yeah, I think so. I think a lot of people just sort of went full out of the market based on the Liberation Day announcements. And then as we saw the slow pivot back into a less of a kind of confrontational approach to this from the Trump administration, everyone found themselves actually net short and started to build positions again. And, that was exacerbated by other more mechanical flows. But overall now we find ourselves with people much more balanced and probably better positioned moving forward.
Right.
Not so long, not so short, but, more cautious, but still in the market.
So maybe back to a more neutral stance. We have 30 seconds left with you. Give us the bearish take. What are all the things that could go wrong over the next half of the year?
Yeah, I think some of your other guests touched upon it. There is more uncertainty now. We're back to this. What will Trump do next? He seems to be on the ropes again. He's lost some credibility. He's obviously being insulted by this sort of taco trade concept. And on top of that, we haven't really got anywhere with the budget bill. Now we have lost the tariff revenue for that bill, and that was actually a tailwind for stocks because it would be more stimulative than thought. Now that may not be the case. Obviously, there's still several more weeks till we get more of a final version from the Senate. All this just creates greater uncertainty. No one wants to step in front of that. And then we're all still sitting here waiting for the hard and soft data to tell us really what the real story is. Are we going to go down to the soft data, which has been weaker, or are we going to come up to the hard data, which is still hanging in a little bit, but cooling?
All right, Michael, great to have you on the program. Bloomberg Markets reporter Michael Ball. You can read his work on the terminal by typing MLIV GO. Coming in the next hour, JP Morgan's Mira Pandit on the muted reaction to the tariff court drama and some soft data at 10 o'clock. We are 30 minutes into the trading day, the last day of the week, the last day of the month, and the S&P 500 is down 0.5% as the gap loses 20% of its value. That's harsh, right?
That is harsh.
Katie Greifeld is here with me. I'm Matt Miller.
And I, as Matt said, am Katie Greifeld. We're looking at a little bit of a downdraft on muted trading volume right now. This could spice things up. We do have University of Michigan data coming in, the final read for May. Sentiment improving a little bit, improving to 52.2 versus the prior read of 50.8. This is interesting. Take a look at inflation expectations. One-year inflation expectations actually dropping to 6.6%. Which is pretty high, but relative to what the prior read was in the 7s, it's certainly a drop down. Then you take a look at the long-term measure there, 5 to 10-year inflation expectations also dropping to only 4.2%. That certainly looks better than the prior read of 4.6%. Let's get a little bit more detail now with Michael McKee. He is Bloomberg's international economics and policy correspondent. And this is soft data, of course, but it looks pretty good. Sentiment improving and inflation expectations coming down.
Well, it does follow the pattern that we saw with the conference board, although it is a little different, Katie, in that the big news in the conference board numbers was in the expectations index, which really jumped. We're not seeing a jump here, just a little bit of a rise, and it's still below 50. So people in the Michigan survey are not as optimistic going forward. The conference board's one-year ahead inflation number fell from 7 to 6.5%. So we're seeing about the same move here now. That may be because gasoline prices are coming down and food prices have come down a little bit. That may be the good news. What everybody always looks at with the Michigan numbers, of course, is what the political aspect of it is. And we're seeing that Democrats were more pessimistic this month, 33.9 from 34.4. And even Republican optimism was down. The number is 84.2 from 90.2. It's independents where we saw some increase in optimism, 48.2 from 46.2. So it does look like the middle of the country, which doesn't have as much of a dog in the fight politically, is feeling a little bit better about things. But again, 48.2 is still below the 50 break-even point.
Mike, I got to ask you about the importance of consumer sentiment data. You know, we got a blowout number a few days ago, I think, from the conference board, and Jay Hatfield was on and said, you know what, that just means that on that day there was good news or bad news. Like, it really has no effect on the hard data. What do you think about that? Because it seems to me, and painful to say as a Buckeyes fan, but Mich is very well respected.
Well, and so is the conference board. But the thing is we have learned over the years, and there have been a lot of studies on this, that what people tell the surveyors about how they're feeling about the economy doesn't always track with what they're doing about the economy. You look at both the numbers for the Michigan survey today and the conference board last week, and you see that they were up, but consumer spending fell off during the month. And that was likely because everybody spent so much earlier in March and February trying to pull ahead of the tariffs. So it doesn't really give us a hint as to where we're going from here, just that people feel a little bit better. And again, even the conference board expectations number that jumped was below the historical average of where it normally is. So it's not like people are feeling really happy right now. It's just a slight improvement over where they were.
All right, Mike, thanks very much. Michael McKee there, our international politics and economics, policy and economics correspondent out of, for some reason, Dallas. Who knows why he's in the Big D. We don't ask those questions all the time. We just let him, roll. He does what he does. Yeah. Joining us now is Mira Pandit, JP Morgan Asset Management Global Market Strategist. Mira, how much attention do you pay to this soft data? As we've all been waiting for it to migrate to the hard, but we haven't really seen bad hard data.
We are in the continuing saga between soft data and hard data, this epic battle. And what we're seeing is that, look, the hard data is still looking pretty good. And now we can start to put a little bit more credence behind that because it is reflecting an economy that does acknowledge some degree of tariffs, but also tariff risks are not eliminated, but becoming more and more mitigated. So the hard data becomes a little bit more telling. The soft data is starting to contradict the hard data a little bit less as well. Consumer confidence expectations jumping. You're seeing in the regional Fed surveys some of those CapEx intentions starting to turn around. You're seeing from the standpoint of the Michigan sentiment, a little bit of turnaround there as well. Some of the measures of CEO confidence have started to turn around. In addition, so I do still think this mosaic of data is supporting the picture of an economy that's undoubtedly slowing, but not stalling out or headed for disaster.
Well, we have a great chart, and I hope we can pull it up, that if you take a look at how many times CEOs said some version of the word uncertain during this past earnings season, it was higher than even the second quarter of 2020. Over 3,100 times that word was mentioned. And it's really interesting to marry that with the actual facts on the ground, which is it feels like things didn't go as badly as expected. You had some companies pull their guidance, but not everyone en masse. And you take a look at the S&P 500, up more than 5% in May.
There's
alone.
the great chart.
There you go. You can see it. So, I mean, it sort of gets back to hard versus soft data. How do you marry together those feelings and those emotions and uncertainty with the fact that this market is ripping?
If you look at a long time series of hard data versus soft data, during the periods when they gap out the most, the hard data tends to be above the soft data. So sometimes people feel really crummy, but it doesn't necessarily impact how they're acting. Now, businesses maybe is a little bit different because CEOs tend to want to batten down the hatches a little bit, think about hiring, think about CapEx spending in short order. But on the consumer side, you often see that consumers are engaged in retail therapy. And so right now, it's not just around consumption, but it's actually around the stock market where you're seeing a lot of retail investors buying the dip. So in the end, we could see that consumers not only support the economy and make it more resilient, but certainly they've been supporting the stock market as well.
Yeah, Matt, it's funny. We saw something similar during the pandemic where all the survey measures of sentiment were absolutely in the gutter, but consumers never stopped spending. And in the stock market, it doesn't look like they're stopping buying there either.
Will we avoid a recession, Mira? I mean, I guess we could have a technical recession because the pull forward of demand hit us so hard on GDP, technically, in the first quarter. We could have that again, right? Because we have this 90-day thing out until July.
What I'd say is, one, if we think about businesses pulling back, businesses are about 13% of the economy in terms of capital spending, while the consumer is 68%. So we want to overweight what the consumer is doing relative to businesses. What I'd also say is, yes, this pull forward in demand is significant on both the business and consumer side, but what it means is that businesses and consumers have the wherewithal to pull forward and build inventory and import more and buy more stuff. So even if we start to see a little bit of a drag, it still shows that underneath the surface, these two major actors of the economy are still reasonably intact. And so from our view, we do think we can avoid a recession this year as some of these risks, again, have been mitigated but not eliminated. And we're somewhat back to December in terms of how we're thinking about our outlook. Undoubtedly, growth is probably going to slow, given the very high growth we've had over the last couple of years. And yet it doesn't necessarily look like we might be pushed all the way into recession because of some of this spending, because the unemployment rate still looks very low and is stably low.
Right.
Psychologically, that's good for consumers. Not a lot of cyclical excess, a lot of corporate debt termed out for a long period of time. A lot of consumers holding mortgages that have been initiated at very low interest rates or refinanced. So there's not a lot of boogeymen in the economy, so to speak.
I think it's interesting that the corporate only contributes 16%, did you say?
13 in terms of business.
13%.
In terms of business fixed investment.
Even with the CapEx, the massive CapEx we're expecting for AI, do you expect that to move the scale a little bit?
I think it can help. I mean, it depends if other companies pull back, but you have seen impressive results from the Mag 7 with them reaffirming some of that CapEx guidance, robust hiring with some of those companies. You're seeing evidence that AI usage and monetization is increasing. So it's going to be a different story across different areas of corporate America, certain sectors certainly pulling back, but it has been remarkable to see throughout earnings season, those Mag 7 earnings surprises really bottomed in 2Q 2024 and have been steadily rising since then. So it could be another year where Mag 7 is really holding up profit growth while some of the broader weakness weighs on other areas. You saw 2% upward revisions prior to NVIDIA to Mag 7 earnings for the year. relative to downward revisions to everything else. So some of these dynamics we certainly have to keep in mind when it comes to profits, the economy, capital spending. It all knits together.
All right, that's a good place to leave it. Mira, have a great weekend when you get there. That is Mira Pandit of JP Morgan Asset Management. Meanwhile, a quick check on these markets. We're about 40 minutes into this trading day, the last trading day of the month. Things could get weird around the close, but right now it looks pretty tame. You take a look at the S&P 500, down slightly, about 0.2%. The NASDAQ 100 not too much far behind, down about 0.3%. The bond market pretty well behaved. Volume is pretty low right now, trading volume relative to its 30-day average, but that could change, Matt.
Yeah, absolutely. I mean, you could see some window dressing into the close. It could be one of those witching days.
Yeah.
Who knows what that really means.
Multiple witches, perhaps?
Yeah, it could be. It could be, but that doesn't usually seem to really move the needle. Let's get a look at some of the single stocks moving at this hour. Dell is higher after it said it's seen significant increase in orders for servers to run AI networks. Remember, we're all moving on-prem and out of the cloud. Ulta results topping Wall Street estimates as shoppers continue to spend on beauty products, and shares of the Gap are absolutely plunging after the apparel company warned the impact from tariffs could reach $300 million.
And coming up in the next block, we'll be speaking to the CEO of Gap, Richard Dixon. You don't want to miss that conversation. This is Open Interest.
Let's get to high interest now. Look at what's making headlines around the world. President Trump is accusing China of violating an agreement with the U.S. to ease tariffs, escalating tensions further between the two countries. The president didn't specify how China had broken the agreement negotiated earlier this month in Switzerland, but he did say it in all caps. At that time, both countries said they would scale back tit-for-tat tariffs and continue trade talks. Good news for summer travelers. United Airlines sees ticket prices a little bit lower than expected for spring and summer, according to the company's chief commercial officer. He also forecast a very busy summer with Japan and Southern Europe as the most popular destinations for us in the U.S. And Costco is posting better than expected earnings in the third quarter. It's a sign that the nation's largest club chain is successfully navigating tariffs and economic turbulence, at least so far. Costco price increases are expected to hit later in the year as the company starts to sell new inventory. But Katie, they're going through these things on a product-by-product basis.
Right. Well, we're going to be talking about tariffs, of course, and inventory in a big way with the Gap CEO, Richard Dixon. Gap shares currently down about 20%. That is pretty bad, but somehow that's only the worst drop since April 3rd, of course, the day after Liberation Day. We'll talk through how the company is navigating and plans to mitigate up to $300 million in tariff impacts next. This is Open Interest. All right, it's time now for our Wall Street Week conversation. And for many years, the U.S. has led the world in innovation, driven in a large part by government funding for university research. But as Scarlet Fu reports, that could be about to change with deep cuts President Trump is making to institutions such as Harvard and Columbia.
Decades of government-funded research has attracted a pipeline of talent, homegrown and increasingly from outside the U.S. When you think of America's most cutting-edge companies, they often share some common traits: giant market caps, global reach, and oftentimes founders and/or CEOs born and raised abroad and educated in America.
I believe that it's nearly half of Fortune 500 CEOs that are either immigrants or children of immigrants.
Who's the next leader of a big multinational American company? There's a 1 in 5 chance that they were an international student.
The U.S. represents the premier destination for international students around the world.
What's become clear is as much as U.S. research universities depend on federal government money to operate and fund their research, they also depend on international students for the same, starting with paying tuition. That has come under direct threat when the Trump administration announced it would bar Harvard from enrolling international students, while the State Department halts interviews for student visas. A federal court has temporarily blocked the ban on Harvard.
Over 200,000 international students work in the U.S.
Miriam Feldblum is the president and CEO of the President's Alliance on Higher Education and Immigration.
Overall, the Department of Commerce has estimated that international students contributed $50 billion to the U.S. economy in 2023-24. That actually makes international education kind of the 10th largest export in the U.S. Even though the students are coming here, international students are only 6% of total student enrollment in higher education. So we're not talking about a large population, but the contributions that international students provide by their skills, their talents, what they buy, what they do, is far greater than what the 6% would indicate.
As the Trump administration cracks down on public funding to universities and visas for international students, other countries like Canada, Australia, and the UK are stepping up their recruitment efforts.
The administration's rhetoric would just discourage international students from choosing the U.S. as a destination, and they end up gravitating away from the country. Is that something you think about?
Every day. There's no doubt that if there's continued rhetoric, policy proposals, and actions that discourage international students from coming, that impact will be seen in decreased enrollments in the fall.
Does it lead to the closure of certain programs, certain innovative programs, or certain potential research breakthroughs?
We know, based on history, based on research, that our research productivity will diminish. Probably the number of patents being filed will decline based on past history. We don't know what will be lost. We know things will be lost. And this isn't about international students or international talent or domestic talent. The U.S. needs talent.
And Cornell Tech and Johns Hopkins University received donations from Michael R. Bloomberg, the founder and majority owner of Bloomberg LP. You can catch Wall Street Week every Friday at 6 p.m. New York time.
Meanwhile, more trade uncertainty as President Trump says China totally violated its trade agreement with the U.S. Bloomberg Balance of Power co-host Kayleigh Lyons has the latest. And Kayleigh, first of all, it's great to have you here in New York again today. President Trump tweeted this in all caps, but didn't give any details as to how China violated the agreement. Do we have any idea?
Well, we have an idea not from the president, but from others in his orbit, including the U.S. Trade Representative Jamieson Greer, who on another network said specifically that we aren't seeing the flows from China we were supposed to in terms of critical minerals, because in addition to this agreement taking the level of tariffs way down from the sky-high levels at which they were, it was also about making sure that some of the other non-tariff measures that China had taken in retaliation for the U.S. Slapping on these tariffs, like restricting the flows of critical minerals, were supposed to be eased as well. And Greer suggested that's not what we're seeing from China. This follows the Treasury Secretary Scott Bessent saying things that are really stalling out in trade negotiations between the U.S. and China, keeping in mind that the U.S. has, in just the last week or so, taken further action that could really be irritating China. The restriction of student visas or the revoking of them from Chinese students at American universities, also further restrictions around export controls, not just of semiconductor manufacturing equipment or chips themselves, but now software designs, semiconductor software designing thing as well. So they're seeing the tightening of export controls, other areas of tension in the relationship, and that may be making it more difficult for this to proceed in a positive direction.
Right, non-tariff barriers this time coming from the U.S. to China. But Kayleigh, I want to get your thoughts on some breaking news that we just got from the Supreme Court. Let me read the headlines now. That the Supreme Court, for now, is letting President Trump strip 500,000 migrants of legal status. In this case, siding with Trump for now in that immigration case. These headlines just dropping in the past couple minutes. What do we know so far?
Yeah, so this was a lower court order that said the administration had to, or the legal temporary status for these individuals from 4 countries, Cuba, Haiti, Nicaragua, and Venezuela, did have to stand for now while this process plays out in court. The administration, President Trump, had asked the Supreme Court to essentially allow him to revoke that legal status for now, and The court has done so. The operative words, though, are for now. This once again is an instance of the court agreeing with the administration, at least in the interim, that they can do as they want. We've seen this with hundreds of thousands of Venezuelan migrants as well, but the legal battle is not actually done. By no means is this definitive, saying the status will be revoked permanently, but they are allowing the president to do that at this time while we see it playing out further in lower courts.
All right, Kaylee Lyons, really appreciate the reporting, and great to see you in New York. That is Balance of Power co-host Kaylee Lyons. Let's get back to one of the big corporate stories of today, and that is shares of Gap plunging this morning after the retailer predicted its tariff impact could be as much as $300 million. Let's get right now to the CEO of Gap. His name is Richard Dixon. And Richard, it's great to have you with us. Normally I would ask about the results themselves, but I have to start with the share price, down 19.8% at the moment. Matt and I were talking about earlier how CEOs often come on this program and tell us that they don't watch the day-to-day movements, but I feel like this move is hard to miss, Richard. So what do you do with this? What does the rest of your day look like? Are you having all hands meetings? Are you in conversations with your board? What does it look like?
Well, I think it's true. I mean, we don't manage our day-to-day business focused on our daily stock movement. Clearly, it's a dynamic market out there. But much more importantly is that our brand reinvigoration is working. And it showed up in our results. We delivered another great quarter, a consistently great quarter. We exceeded expectations across all key financial metrics. Our strategic priorities are clear. And despite a dynamic environment, we're staying firmly on course. And it's showing up in the results. Comps were up 2%. That's the 5th consecutive quarter of positive comps. It's also the 9th consecutive quarter that we gained market share, which indicates our product is resonating. We expanded both gross margin and operating margin during the quarter. We controlled expenses. We increased our EPS by 24%. We strengthened our balance sheet. We have a strong cash flow balance, and we've got $2.2 billion. The Q is really another proof point that the strategy is working. I remain incredibly optimistic, yet realistic, about the opportunities ahead, and we're all navigating a highly dynamic environment.
I have to say, though, that your company has lost fully 1/5 of its value today. So you were worth over $10 billion in market cap, and now it's $8 billion. That's the kind of thing that you just can't look away from. And it looks like that's all down to the tariff impact headline, which you said as much as $300 million. That's less than 1% of your operating income. I mean, you have $15 billion in sales, so it's a seemingly small number. Don't you need, Richard, to analyze why the market is attributing so much to this relatively small number?
Look, of course, we're on top of and studying, obviously, the marketplace and the reaction, but we are running a business for the long term. And like any business, we're constantly navigating complexities. In this case, it's tariffs. But it's our responsibility to do so without compromising the long-term integrity of our strategy. And most important to the extent of that strategy is our consumer value proposition, which is resonating. Now, in relation to the tariff conversation, we did share that we've already mitigated over half of the anticipated impact tariff. We've done it through very thoughtful adjustments to sourcing and manufacturing and our assortments. We also shared that we remain committed to achieving the remaining net impact of about $100 to $150 million, primarily also weighted to the back half. Now, we've been diversifying our sourcing footprint for several years. China, as an example, used to be a top sourcing country for us, and now we also shared that we expect it to be less than 3% by year end. So at the end of 2026, we're also planning for no country to account for more than 25%.
Right.
So our goal, first and foremost with our investors, is transparency. And we were very purposeful in separating the outlook from the estimated tariff impact. And we believe that the outlook is providing a perspective on the underlying health of our business, which is working as evidenced by our performance. As well, we shared the estimate of the impact of the tariffs, which could still change. As of a couple days ago, it was also changing. July 9th is also another milestone moment with yet another update on tariffs. So the estimated tariff provided that we shared was primarily weighted to the back half, and we'll continue to update as we move along. But we're very focused on executing our playbook. It is showing up. Our two biggest brands, Gap and Old Navy, are winning in the marketplace.
Right.
We're building stronger identities. We're driving new customers to our site. And we're very excited about, obviously, the back half of 2025.
Well, Richard, it's a fair point that the tariff landscape, it changes day to day, hour to hour in some cases. So we'll keep a close eye on that. Let's talk a little bit more about your portfolio. You mentioned Old Navy. You mentioned Gap doing very well and performing strongly in this market. But talk to us a little bit more about Athleta, about Banana Republic, which haven't seen that same momentum. How do you specifically plan to revitalize those brands?
Well, as you mentioned, first let's start with Old Navy, because Old Navy is our largest brand in the portfolio, and it continues to deliver. This is the 9th consecutive quarter of market share gains. Comps were up 3%. We're winning in the categories that we've intended to drive. Active and denim. We've been pursuing a leadership position, and the market share continues to gain quarter after quarter. We also just introduced Old Navy New Moves, a new campaign that really solidifies and supports our activewear strategy. It is a clear example of how we're accelerating Old Navy's adoption of our playbook. We take big ideas and big product categories, we amplify them with great storytelling, and then we connect them to the consumer. Denim was another standout category. Share gains across that category. We're the 4th largest adult denim brand in the U.S. And these are real elements that we can count on that are giving us the confidence that ultimately we're going to deliver in 2025. Gap is another brand that's gaining momentum. We're incredibly proud of the progress that we're making with Gap. Comps up 5%, 8 consecutive quarters of market share gains. Incredible performance based on innovation, product newness, compelling marketing, collaborations that are driving a whole new generation to Gap. Recent campaign with Parker Posey, which resonated with consumers. A great example, again, of our playbook, and the strength of that brand is going to continue, and we believe Gap is well positioned to continue the momentum.
Right.
Banana Republic is a brand that we've been reestablishing. Fundamentals are improving. We were flat for the quarter. We're seeing trends continue in men's, which we're very proud of. And the team has done a great job strategically deploying more marketing to culturally relevant storytelling. Our women's business is starting to take traction. The collaboration with White Lotus was incredible, and we believe that that brand, quarter after quarter, is starting to see great progress. And lastly, just to finish up our portfolio, Athleta is an incredible, valuable place in our portfolio. And in the industry, by the way. We've been resetting that brand to more effectively compete in the marketplace. We did share that we expected to be a bit choppy as we continue to fix the fundamentals. We provided that outlook yesterday in our call. But Athleta needs to become a much more exciting brand for our consumer. We had an over-rotation that we discussed last quarter towards new consumers, which we did attract. But we still didn't have enough compelling product to appeal to our large consumer base, and it showed in the performance. So we're investing in design talent, we're driving newness into the brand, and we have more work to do, but we're committed to really taking the necessary steps to reset that brand.
Richard, you seem to have a particular affection for Banana Republic. You're personally running that brand. Are you any closer, though, to finding someone else to do some of that work for you?
We've met some extraordinary talent. We are very close to what we believe will be the right pick at the right time. And as you see, we're continuing to strengthen the brand. So as much as obviously we're sort of looking for the right person, we take these positions very seriously, and we want to make sure that we have the right talent that can take that brand and drive it to the next level.
All right, Richard, thanks so much for your time. Really appreciate it. Gap CEO Richard Dickson talking to us about his results. Let's get a quick check on what's going on in the markets right now. We're looking at a little change on the S&P 500, 5907, the level there after a bigger drop earlier in the session, although, you know, it wasn't huge. But it does look like, Katie, we're getting back a little bit as we finish out the week, finish out the month to maybe closer to turning to a higher?
We'll see. We're 6% higher on the month. I would say that the time to, I mean, stay tuned right now, but the time to tune in is also 3:30 p.m. because that half-hour window to the close on month end will be interesting.
So you're actively promoting Romaine Bostick's show.
I am. I mean,
that's what we do. We care about.
It should be electric.
All of the brands here.
You know, the open promoting the close. It makes sense, but it is interesting. You know, that conversation we had with Richard Dixon, and we did press him a bit on the share reaction today.
Well, you have to when the shares fall 20%.
To be fair, the expectations were sky high for Gap because take a look at the year-to-date chart. Through yesterday's close, this stock was 19% higher on a total return basis for 2025. You compare that to the rest of the consumer discretionary sector, obviously well outperforming. So you can really see what a big bite today is taking out of that year-to-date performance. Now negative on the year, so we'll continue to see how that trade develops. But let's take a look at some of the other single stocks moving this hour. We're going to do that with Bloomberg cross-asset reporter Denitsa Seikova. And do you have any positive news for us?
Yeah, let's start with Costco. We've been talking about consumer, only bad consumer news, but I'm going to bring some good ones. Costco posted better than expected earnings. Of course, everyone has been worried about tariffs and economic uncertainty. And so far, what we're seeing from this earnings report is that Costco defies all those warnings. The retailer said it generated earnings per share of $4.28, which is well above what the street expected. We saw a lot of warnings from Target, from Procter & Gamble. Obviously, Walmart had solid results, but everyone is watching that space. It's been under a lot of scrutiny, but Costco remains very strong, more than 10% gain year to date, showing strong consumer. That said, they said that they will raise prices later this year, but it will be based on item by item. They're putting some prices down. Obviously, egg prices are going down, but raising some prices according to the tariffs.
Is Costco is that the one with the hot dogs that cost $1?
Of course,
that is
$1.50. Yeah,
I've never had one, but
I haven't.
You've never been to Costco, or you've never had one of the hot dogs?
I've never had a Costco hot dog. It's not.
I haven't as well, but it's legendary.
I'm sure Matt has.
Yeah, no, I've definitely participated in that offering. You know, it's interesting. American Eagle, like we just talked to Richard Dixon from Gap, right? Their shares are down 20%.
Yeah.
Abercrombie and Fitch, to be fair to Gap, right? They're getting crushed. They're off like 40% year to date.
Yeah.
American Eagle is, you know, the year-to-date picture is bad also, down 30%. But those shares have turned higher on the day, even though they had weaker sales and more discounting.
It's an incredible reversal story. It was, when I was writing this, it was down about 8%. Now we're in positive territory. As you said, this is a different picture from Gap, because the stock is actually down 32% year from date. So perhaps investors saw maybe a dip buying opportunity. That said, the report we saw today indeed brought more negative news. The firm forecasted operating income for the second quarter missed what analysts were expecting. They said the fiscal 2025 guidance remains withdrawn amid uncertainty. There are all those fears about consumers. We saw weak sales from both of their brands, and we saw a lot of discounts. So if you look at what we've heard from analysts and price target, there isn't too much optimism about the stock. But of course, we saw a big reversal today. So perhaps there is some optimism or some dip buying from the super low levels.
Yeah, still a brutal year-to-date chart there for American Eagle. Let's talk a little bit about a different industry and talk about Marvell Technology, also coming out with earnings. Seems like traders aren't too happy with it.
Yeah, this wasn't a bad report. It was actually in line with expectation. But this, of course, we're going back to AI, we're going back to chip makers, and all those companies having very high valuations. And this was exactly where we saw a slightly disappointing report, but the reaction was pretty bad. It was down as much as 8%. Now some of those losses are fading, but still a pretty rough day for a report that wasn't that bad. What analysts are seeing is that they're seeing lack of upside in data centers in the first and the second quarter, and generally people are saying that they are not seeing a massive payoff for that AI investment and AI hype. The stock is down a lot this year. If you zoom out, it's down more than 40%. It's also a day when Nvidia is down, so I feel though that weighs definitely on the whole field. But it's been a rough year and another rough day today.
Yeah, even over the last 5 years, they haven't doubled. So they're only up 90%, which
Pedestrian.
In the AI chip space.
In the AI chip space.
It's basically unchanged.
Exactly.
Yeah.
Danita, thanks so much for joining us. Danita Tsakova from the Cross Asset team actually sits right near Katie on the other side of the building. Coming up, the president wants to bring manufacturing back to the U.S., but do we have the labor force to fill those positions? Well, we have an expert to talk about this. Janice Bryant Howard, Act One Group founder and CEO next. This is Open Interest. Fresh labor data showing a strain on the job force, with jobless claims hitting a multi-year high. Let's get a read on the labor market itself with Janice Bryant Howard. She is the founder and CEO of the Act One Group. Act One is a workforce solutions and technology company that supports clients across more than 43 countries. JBH, great to have you here in the studio. Thanks so much for visiting us at 731 Lex. What's your take, first off, on the state of the labor force right now? We're all watching very closely to see if companies start to lay off more, companies start to fire, and it doesn't seem to have happened quite yet.
No, it hasn't happened quite yet. And at risk of seeming overly optimistic, Matt, I have to tell you that I think we're in a great moment for opportunity. Now, most people think immediately, okay, so you're just going back to that meaning of opportunity is another way of saying challenge. Yes, I am. However, there's a really positive upside to it. And you're asking about the labor market and people not really being laid off so much right now in the commercial sector, that's what we're finding as well. However, how the labor market continues and how individuals retain their jobs is going to depend a lot on their readiness for the new way we do work.
Well, let's talk about that a little bit more, because you talk about potentially the new way we will do work. My mind goes straight to AI. There's all these prediction out there about how AI is going to change our daily life, but also how we actually work and earn a living. And I'm wondering what impacts you're starting to see when it comes to AI and the workforce.
You're generous to bring that up, Katie, because AI's been around for a long time. I mean, since the 50s, and it's already impacted how we live. I think because there's such a phenomenal jump now with the chat GPT-ness of things, people are becoming more aware of it in their daily lives because they're using it more in their daily lives. But your automobiles have been there for you for quite some time, over a decade, integrating this type of technology. Understand there's a difference between AI and AI agentic. And what you're leaning in on, Matt, when you ask about the labor market, agentic workforce is where we're seeing opportunity. And that's why companies don't need to lay people off, because they can team up in new areas or in highly transactional areas with an agentic worker that then supports their human worker.
Yeah.
Human in the loop is really key to how we do anything, whether we're doing that in the U.S. or whether we are doing it across the 43 countries you mentioned. Act One, sir.
I think it's fascinating that you're thinking on the AI level and how people do, I think, really high-paid work. When I think of the labor force, I think of the factory floor. And clearly, that has diminished in the U.S. over the past 5 decades, but President Trump is looking to bring that kind of manufacturing job back. You know, there was a time when one salary from a manufacturing job could support the whole family. Is that ever coming back? Janice, do you ever see manufacturing jobs coming back to this country in force?
It's not coming back. We're not going to do things the way we did, nor do we want to. Recently, I visited my hometown of Tarboro, North Carolina. And when I grew up, factories were the good jobs in town, right? And my dad was a factory worker. The way he did work will not come back, but the work he did will come back. And those factory workers you're talking about being a one-income earner for a family, that still can exist in manufacturing. It's going to exist in a different way. Robots are not going to replace people. They're going to enhance what people do. And so workers are going to need to upskill or reskill to the environments they get placed in. Here's the good thing if you're concerned about the cost of skill. Universities will not go out of fashion, and I know there's a lot of conversation right now about universities in this country as well. Community colleges are supporting people to become the new millionaires. When you think of plumbers, you think of people who do utility type work. But in the manufacturing space, wages aren't going to go down. The work that the manufacturing worker does will go up and will be highly enhanced in a human-in-the-loop environment.
Right. Well, Janice, you hit on a very cynical concern of mine, which is that we're going to try to...
Oh, you don't look like a cynic at all.
Well, you know, let's take a peek inside.
Looks can be deceiving.
That is certainly true. But
you're looking great, Katie. What's the question?
A cynical concern I have is that, you know, we're going to work to revitalize the manufacturing industry. We're going to bring back or create all of these jobs, and then just in the next decade or so, we're going to replace everyone with robots. It sounds like what you're saying is you don't necessarily see it unfolding that way.
You know, there is some work that will be robotically replaced, okay? Now, when I'm in Los Angeles, I see all the cars rolling around without a driver, okay? That is not going to be the ultimate for the workforce. We will learn to work differently. Years ago, I told a story of how when I visited my husband's hometown, he shared with me that that was the road that I shared. He said, look, this is the road that I was on the back of a horse and buggy when my family delivered ice.
Wow.
And he said, you know, the ice man was one of the most revered people in the community. They delivered, they gave kids chips off the ice. And then one day he showed up to one of his customers and they didn't need him anymore. He thought he was in the ice business, but really he was in the business of refrigeration. And I don't know that you know the brand Frigidaire, but when it came out, it replaced ice workers. So it's understanding what industry you're in, what jobs that what is the outcome of your work, and then upscaling and reskilling to be able to fulfill that. And companies are doing that.
Right.
Gap is a client of ours, and you just talked with Richard. They're a splendid client. They're looking at how they are reviving and revisiting what made them so great and what will keep them so great. And a lot of that is going to, for instance, in our company, let me give you a for instance that can help them. We have recently acquired a business called Assembly Industries. Assembly is an agentic workforce. It goes in and it helps you to identify where you have highly transactional work that needs to occur. This does not replace a worker. This enables a worker to do the things they're skilled at well.
It is.
It continues to keep a human in the loop, but it can work as an independent team member. That's where we're headed. I'm not looking to replace people. I'm looking to enhance how people work, ergo how we all live.
It's a really fascinating point and incredible take. Thank you so much for joining us. Janice Bryant Howard there of the Act One Group. Coming up, Apollo is partnering with JP Morgan and other major banks to trade private credit. We'll bring you the details on that next. This is Bloomberg.
Well, State Street is doubling down on its bid to bring private assets to a broader spectrum of investors, even as its initial ETF experiment in this area has struggled to gain momentum. Let's break it down now with Bloomberg Intelligence ETF analyst Eric Balchunas. So build it and they will come. That didn't necessarily happen the first time around. Why would State Street's second attempt at a private credit ETF go over better?
This is interesting. It's possible that's what they're hearing from their clients. You know, when you have an ETF, you tell your salespeople to go talk to advisors. Maybe the advisors are like, look, I buy something in the short duration area of this, but I'm not going to buy this sort of middle duration. You know, also the active element is way more valuable in short and ultra short. Like, you know, we just discuss this all the time on ETF IQ. Ultra short like the bonds in that category, active makes over half. So maybe they're just finding a little more demand from clients. But I'm with you. It's a little bit of a head scratcher. Priv got a lot of hype, but it was a bit of a flop. I mean, I had 50 million of an anchor tenant in there, but no flow since. Volume is light. I think that just generally private credit just isn't interesting. Doesn't really pack a lot of punch. There's not a ton of private credit in the ETF. I think private equity might have a better shot at capturing the imagination of investors, but we'll see.
Right. Matt, just for context, so Priv, their initial private credit ETF, launched in late February. It's only seen 2 days of net inflows in its entire existence.
I find that nuts, because I don't agree with Eric that it's not interesting.
It is interesting.
I think private credit is interesting, and I feel like more people want to get more retail investors would like to get a hold of that.
That emotion hasn't translated into flows. And Eric, I want to talk about wrappers here. Of course, you and I are ETF people, so this might be sacrilegious, but it seems like interval funds, more and more issuers are gravitating towards interval funds for retail access to private assets versus ETFs.
Yeah, Vanguard has something coming out, Blackstone. We'll see. I'm skeptical on interval funds. To me, they are essentially a mutual fund. And so it's like going backwards. It's like you have this cool new investment strategy, but you're putting it in like a compact disc or a cassette tape. Nobody really wants to consume anything that way anymore. So I don't think interval funds are going to work. Also, let me tell you this. ARK has an interval fund that's 100% privates, the ARK Venture Fund. And it was launched at peak ARK Mania, has about 150 million. Meanwhile, XOVR, this random fund added SpaceX, only 10% SpaceX, and the rest is public stocks. 350 million came in like 2 months. So to me, I think people really want private equity in the ETF. That would be the hot area. I think private credit, I know it's interesting for institutions. I just don't think it's that interesting for advisors or retail. And I think the wrapper of the ETF is where they want to have it. I don't really think you're going to find many bites in the interval fund. I could be wrong. Some people disagree with me on this. I just think it's a hard sell to go into something with 5 letters in the ticker.
Yeah, we'll see. Maybe people like.
Can I just ask? We only have a minute left, but who is your favorite rapper, Eric?
Oh my gosh.
Can I say the Beastie Boys? I'm Gen X.
Yes, you can say that.
I like the old. I like Kool Moe Dee. I like that late '80s rap where they use thematic imagery. And whatnot.
I'm like a Public Enemy guy. Katie, what about you?
I don't know if I have a favorite rapper. So my favorite rapper is the ETF rapper. I'm going to leave it at that. Eric Balchunas of Bloomberg Intelligence. Have a great weekend. Tune in to me and Eric and Scarlet Fu on ETF IQ on Mondays at 12 p.m. New York time.
That's the name of your show.
Yes. Please also subscribe to the ETF IQ newsletter, Bloomberg.com/ETF IQ newsletter. It's how I feed my cat. So please subscribe and then open it.
So the show and the newsletter are both ETF IQ.
We're consolidating the brands.
I love it.
Yeah.
Coming up on Monday, Stuart Kaiser joins us from Citi, Raquel Oden from HSBC, and Henrietta Treyz from Veda Partners. Have a fantastic weekend.
From the heart of where innovation, money, and power collide in Silicon Valley and beyond, this is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
Live from San Francisco, this is Bloomberg Technology. Coming up, US President Trump accuses China of violating an agreement with the US to ease tariffs, escalating tensions between the two countries. Plus, sales of Apple's iPhone are set to take a big hit from Trump's new tariff policy. We get into the numbers, and we speak with the CEO of AWS as the leading hyperscaler runs faster on AI. What a week it has been in the world of technology. I'm looking at the NASDAQ 100. It is a mega cap and technology heavy index. And over the course of the week, we're up a percentage point. We're actually lower in Friday's session, but this is a rebound from last week where earnings and that tariff story have been the driver of the markets and the headlines. There are two names in particular that we have been so focused on. Those names are NVIDIA. Of course, we had earnings 24 hours ago, 38 hours ago, 48 hours ago, and then we spoke to Jensen Huang. It's giving some of the gains that it has seen back, but there is a big question still about China and cross-border trade of the lead-edge technology, and then Apple again, softer, 0.4%. Just 24 hours ago, NVIDIA was the world's most valuable company. Apple had regained some status as the $3 trillion club. We're under pressure. Now, here's the top story. China's planning to allocate $70 billion of capital in a new effort to fast-track new infrastructure projects and shore up its own economy from ongoing US tariffs. That's according to sources. Meanwhile, President Trump reigniting those tariff war concerns, posting on Truth Social that China has, quote, totally violated its agreement with US or us, offering no details of what agreements China could have violated. Let's get more from Bloomberg's Mike Shepard. Do we know what the president is talking about here?
Well, we haven't gotten a clear signal from him directly about what had set him off this morning. But we have seen, Ed, over the past few weeks, since that sit-down in Geneva between Treasury Secretary Scott Bessent and his Chinese counterparts, sign that little agreement, that détente that they had forged there in Switzerland was starting to come apart. The Chinese government had objected to some export controls that the U.S. has increasingly been applying to China, keeping advanced technology from getting in there. And of course, this has been a sore spot for Beijing for years with limits on exports of semiconductors, but they have been escalating. And in more recent weeks, we even saw the U.S. go after makers of chip design software, telling them essentially, you can't sell to China without violating our export restrictions. So that is something that already Beijing was seeing as a violation of the spirit of those conversations. We had heard that a week ago. But now today, we hear from the top U.S. trade negotiator, Jameson Greer, talking about rare earths and critical minerals. And during that discussion in Geneva, the two sides had agreed that Beijing might lift some of the barriers that it had placed in retaliation for U.S. export curbs on exports to the U.S. of critical minerals. So there is a bit of tit for tat that we are seeing here, and it may be bubbling over in the form of Donald Trump's Truth Social feed here today, Ed.
You know, I'm reading the news on the Bloomberg terminal, and I go back to what Michael Kratsios, who runs the White House Office of Science and Technology, told us. The policy from this administration is promote and protect. Protect is the tariffs bit, right? Promote is onshoring and stimulus for the tech industry. China is doing the same thing. Right? It's trying to drum up some money, $70 billion we're reporting, for its own industries in China. What do we know about that?
Well, and that's a good question. I'm glad you brought that up, Ed, because it's unclear whether the administration here is responding to that report of additional Chinese stimulus toward artificial intelligence and other high-tech projects that they have planned as a way to spark their economy and make sure that they have some domestic demand to satisfy the industry it is trying to cultivate. But nonetheless, it would not sit well with the U.S. administration here because they are trying to bring some of that manufacturing to American shores, to try to build up the American American tech manufacturing base. And we've seen so much of it, especially in semiconductors over decades, move to Asia. And Donald Trump has been applying pressure to none other than Tim Cook, the Apple CEO, to try to get the iPhone production moved here. Of course, in our conversations with Mark Gurman and so many others, we know that that is a bit of a pipe dream, but nonetheless, it is a priority for the administration. And so you do see, as you said from your interview with Michael Kratsios, this desire to promote American tech here at home, but also protect it against the challenge it sees coming from China.
Bloomberg's Mike Shepard, do not go far. I have a sense more news is coming on those topics. Meanwhile, sales of Apple's iPhone and those of its rivals are set to take a significant blow from President Trump's tariffs. IDC research showing smartphone growth of just 0.6% post-tariffs. For more, Nabila Popal, IDC Senior Research Director, joins us. I always track your data, not just the backward-looking data, but extrapolating out and looking forward. You've kind of now got the post-tariff scenario. Just explain what you published overnight and how this impacts, in particular, Apple.
Hi, thank you. Nice to be here as always. Yeah, so exactly. And whenever we publish our forecast, we always like to show what was the scenario before, right? So in our latest forecast, which we just published, we're showing a flat growth. And it's really important to see how that's changed, right? Because 24 was, the year of, we had like 23 was, we basically, we've been in a few years of decline, and the 24, exactly, thank you for showing that up, was a big year of growth. And then 25 was supposed to continue this growth, but we were supposed to have about 2%, 2.3%, continued recovery. But since February, when was our last forecast was published, we've been going through such tumultuous times, right? There's been a whirlwind of uncertainty. You've seen that word thrown around many times. We've had to pull down the forecast because of obviously high uncertainty, so much tariffs, supply chain turmoil, and there's a lot of, just soft demand across the board in large global markets.
I'm trying to understand policy and how you factor policy into that model, right? So the situation was that smartphones were given a tariff exemption. That was mid-April. Then President Donald Trump, just this month, May, said that for smartphones made outside of America, there should be well, let's be honest, not just smartphones, the iPhone made outside of America, there should be a levy of 25%. How have you factored that in?
So, that came out right actually after we had finalized our forecast. So but we had taken into consideration, right, because we knew that even when the exemptions were announced or wherever the tariffs stood, that it was all temporary, that things could always, change. So we had to draw a line in the sand at some point. But there was, we did bake in that there is, things could always change. So what we're saying to our clients or anyone that essentially asks us this question is that there is a huge downside risk to the U.S. forecast, and the tariffs, the 25% essentially brings would impose the U.S. market, right? It would impact increased prices. It would change the demand, right, to the U.S. market. Right now, we're expecting the U.S. market to grow about 1.9%, and which is actually U.S. and China are what are holding up that flat 0.6% growth that we're seeing globally. But it was pulled down. Both those large markets were previously expected to grow higher. And if this 25% were to go into effect, U.S. market could potentially even go into decline.
We should say that this data from you and the news flow, it doesn't just apply to the iPhone, right? It also applies to other smartphone makers, like on Android OS as well. But this has been our focus, which is Apple, and the pressure that Tim Cook has been under from this administration. The supply chain is a question mark, but right now, do you envisage any impact to pricing of iPhone or any giant shift to where that company manufactures that handset?
So I'll address the second part first, right? Even when President Trump announced this potential 25% for anywhere, he even said, right, it's not just Apple, it would be to any brand, that as long as phones coming into the U.S. were not made in the U.S., they would face potentially 25% or anything wherever they land, right? We do think that despite wherever the tariffs happen to land eventually, if they do, regardless of that, we think smartphone OEMs will continue to diversify outside of China, and Vietnam and India, we said this in our press release, will continue to be the two primary, global hubs for smartphone manufacturing for reasons